What if I told you that some of the world's most dominant companies are trading at a discount right now? While the crowd chases hype, a handful of powerhouse stocks are hiding in plain sight. Leaders in healthcare, e-commerce, social media, automotive, and digital payments. These aren't risky startups. They're global giants with proven track records and massive growth potential the market is overlooking. Today, I'll break down why these 5 companies are so undervalued, the catalysts that could send their stock prices soaring, and how you can analyze them for yourself. If you want to find quality at a great price, this is the video you need to watch. Hit like, subscribe, and let's dive in. First up, let's talk about Novo Nordisk, ticker symbol NVO, a true giant in the world of healthcare that often flies under the radar for many investors. While some companies make headlines for flashy tech or consumer products, Novo Nordisk has quietly become one of the most influential forces in global medicine, shaping the future of how we treat some of the world's most pressing health challenges. You've probably heard of their blockbuster drugs Ozempic and Wegovy. These aren't just popular, they've completely revolutionized the way we approach diabetes and weight management. These medications have become household names, not just for their effectiveness, but for the hope they offer to millions struggling with chronic conditions. Demand for these drugs has skyrocketed, and they're now seen as game changers in both the medical community and the broader public. But here's the thing. Novo Nordisk isn't a one-hit wonder. This company has been at the forefront of diabetes care for over a century, building a reputation for trust, reliability, and relentless innovation. From the early days of insulin discovery to today's cutting-edge therapies, Novo has consistently pushed the boundaries of what's possible in medicine. Their legacy is built on decades of research, patient care, and a commitment to improving lives. Their GLP-1 drugs like Ozempic and Wegovy are opening up a market worth over $100 billion. And the demand is so intense that Novo Nordisk literally can't make enough to keep up. Factories are running at full tilt, and even then, supply can't match the appetite from patients and doctors worldwide. This isn't just a temporary spike, it's a fundamental shift in how chronic diseases are managed, and Novo is at the center of it all. Despite this, some investors worry that the stock's incredible run is over, that maybe the best days are behind it. But that's a short-sighted view. What many are missing is the bigger picture, the future growth story that's just getting started. The healthcare landscape is evolving rapidly, and Novo Nordisk is positioned to benefit from trends that will play out over decades, not just quarters. To meet this surging demand, Novo is investing billions of dollars to expand its manufacturing capacity. Every new facility they build isn't just about making more medicine, it's a catalyst for future revenue growth. These investments are laying the groundwork for Novo to serve even more patients, enter new markets, and solidify its leadership for years to come. And the numbers back it up. Novo Nordisk's financials are nothing short of stellar. Think double-digit revenue growth, industry-leading profit margins, and a research and development pipeline that goes far beyond just Ozempic and Wegovy. Their balance sheet is rock solid, giving them the flexibility to invest in new opportunities and weather any storms that might come their way. But Novo isn't resting on its laurels. The company is pouring resources into innovation, targeting new frontiers like cardiovascular disease and rare conditions that have long been underserved. By diversifying their portfolio, they're not just reducing risk. They're opening up entirely new avenues for growth and impact. Their research teams are working on therapies that could change the standard of care for millions more people. Of course, competition is heating up. Other pharmaceutical giants are racing to catch up, and new entrants are eyeing the lucrative GLP-1 market. But here's the reality. The market is so vast and the need so great that there's room for multiple winners. Novo's first-mover advantage, deep expertise, and established relationships with healthcare providers give it a powerful edge that's hard to replicate. The global addressable market for Novo's products is absolutely massive, especially as healthcare access expands in emerging markets. As more countries invest in healthcare infrastructure and more people gain access to modern medicine, the potential customer base for Novo's therapies grows exponentially. This isn't just a developed world story, it's a global phenomenon. Some skeptics point to concerns about side effects or regulatory hurdles, but so far the clinical data remains robust and overwhelmingly positive. Regulatory agencies around the world continue to approve Novo's drugs, and long-term demand is only increasing as the benefits become clearer and more widely recognized. Analysts are taking notice too. They keep raising their earnings estimates, and time after time, Novo Nordisk keeps beating expectations. This isn't luck. It's the result of disciplined execution, smart strategy, and a relentless focus on delivering value for both patients and shareholders. And let's not forget about shareholder returns. Novo Nordisk is one of the most shareholder-friendly companies in the sector, regularly paying dividends and executing stock buybacks. This shows management's confidence in the business and their commitment to rewarding long-term investors. Novo Nordisk sits at a market cap of about $246.8 billion, posting EPS of 24.97 Danish kroner, with a PE of 14.08. For 2024, revenue came in at DKK 290.40 billion and net income at DKK 100.99 billion. The stock's current price around $55.50 versus a fair value estimate of $109.14 signals a sizable discount on my screens, suggesting the market may still be underpricing the durability of the GLP-1 franchise and the broader metabolic opportunity. The bottom line? Novo Nordisk is a dominant leader in a booming market, with explosive growth ahead that's not yet fully reflected in its stock price. The company's combination of innovation, scale, and financial strength makes it a rare find in today's market. For investors, this is a rare opportunity to own a company that's not only fundamentally changing the future of healthcare, but also profiting handsomely from it. Novo Nordisk isn't just a stock. It's a stake in the future of medicine. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Next up, let's talk about Alibaba, ticker BABA, often called the Amazon of China, but in reality, it's so much more than just an e-commerce platform. Alibaba is a technological powerhouse that has fundamentally transformed the way business is done in China and across Asia. From humble beginnings in Jack Ma's apartment, it has grown into a global juggernaut, touching nearly every aspect of digital life in China. Over the past few years, Alibaba's stock has been battered by a series of regulatory crackdowns and waves of negative sentiment, both at home and abroad. The Chinese government's sweeping reforms hit tech giants hard, and Alibaba was front and center. But here's the thing, these challenges have created a rare opportunity for investors. The stock is now trading at levels that many believe dramatically undervalue its true potential. Alibaba isn't just an online marketplace. It's a vast digital ecosystem that includes e-commerce, cloud computing, logistics, digital payments, and even entertainment. Its platforms like Taobao, Tmall, and Alipay are deeply woven into the daily lives of hundreds of millions of Chinese consumers and businesses. The company's reach extends far beyond retail, powering everything from small businesses to major enterprises with its technology and infrastructure. The regulatory storm that once threatened Alibaba's future has largely passed, and the company has adapted to the new rules. Yet, despite stabilizing, the stock still trades at a single-digit price-to-earnings ratio, almost unheard of for a global tech leader of this scale. For context, most of its Western peers trade at much higher multiples, reflecting investor confidence in their growth. Alibaba's low valuation stands out as a potential bargain. Financially, Alibaba is a cash machine. The company generates billions in free cash flow every year, giving it the flexibility to invest in new growth areas and return value to shareholders. In fact, Alibaba has been aggressively buying back its own shares at these depressed prices, signaling strong confidence from management in the company's future prospects. The long-term growth story is still intact. China's middle class continues to expand, and e-commerce penetration, while high, still has room to grow. As more consumers shift their spending online and embrace digital lifestyles, Alibaba stands to benefit from these powerful demographic and behavioral trends. Don't overlook Alibaba Cloud either. It's the largest cloud provider in China and a key player in Asia, serving businesses of all sizes. As digital transformation accelerates across industries, cloud computing is expected to be a major driver of Alibaba's future growth, with enormous long-term potential. In a bold move, Alibaba is restructuring itself into 6 distinct business units. This strategic shift is designed to unlock hidden value, increase agility, and potentially pave the way for spin-offs or IPOs of its most promising divisions. Each unit can now focus on its core strengths, innovate faster, and respond more nimbly to market changes. Of course, risks remain. China's economic outlook is uncertain, and geopolitical tensions can flare up unexpectedly, but much of this risk is already reflected in Alibaba's current stock price, which has been heavily discounted compared to its global peers. If sentiment toward China or tech stocks improves even slightly, the upside for Alibaba could be massive. The stock is positioned for a powerful rebound if investors regain confidence in the company and the broader Chinese market. Under new management, Alibaba is doubling down on its core e-commerce business and investing heavily in artificial intelligence. The leadership team is focused on fighting back against rising competition, driving innovation, and ensuring Alibaba remains at the forefront of China's digital economy. So ignore the short-term noise and focus on the fundamentals. Alibaba's dominant market position, rock-bottom valuation, huge cash flow, and multiple catalysts on the horizon make it a compelling opportunity for long-term investors. Alibaba Group is the value outlier in Chinese tech with a market cap near $56.85 billion, EPS of 55.20 Chinese yuan, a strikingly low PE of 2.87, 2024 revenue of CNY 996.35 billion, and net income of CNY 130.11 billion. Those multiples reflect heavy macro and regulatory skepticism. If fundamentals stabilize and cloud profitability improves, that gap between price and earnings power can close quickly. For patient investors willing to look past the headlines, Alibaba represents a classic value play with asymmetric upside, a rare chance to own a piece of China's digital future at a deep discount. Third, let's talk about Meta platforms, ticker symbol Meta, the social media titan that's become a daily habit for billions around the globe. Whether you're checking your Facebook feed, sharing moments on Instagram, chatting with friends on WhatsApp, or sending a quick message on Messenger, chances are Meta is woven into your digital life. But this company is far more than just a place for likes and shares. It's a tech powerhouse that's constantly evolving and shaping the way we connect, communicate, and do business. After a brutal 2022 that saw its stock price tumble and investors question its future, Meta staged a remarkable comeback. The company made tough decisions, slashing costs, streamlining operations, and doubling down on what it does best, building platforms that keep people engaged and advertisers coming back. This strategic reset not only restored investor confidence, but also set the stage for a new era of growth. Today, Meta's family of apps, Facebook, Instagram, WhatsApp, and Messenger, reaches an astonishing 3 billion daily users. That's nearly half the world's population logging in, sharing, and interacting every single day. This unmatched scale gives Meta a dominant position in the digital advertising world, allowing businesses of all sizes to reach their audiences with unprecedented precision. Meta's advertising business has not just recovered, it's thriving. Thanks to cutting-edge AI-driven targeting, advertisers can now reach the right people at the right time, maximizing their return on investment. New tools and analytics have made Meta's platforms indispensable for marketers, driving strong revenue growth and reinforcing its leadership in the ad tech space. Yet, despite this impressive turnaround, the market still discounts Meta's stock for two main reasons: its heavy spending on the metaverse and ongoing regulatory risks. Headlines often focus on these challenges, but there's more to the story. It's true. Reality Labs, Meta's division focused on virtual and augmented reality, is burning through cash as it bets big on the future of immersive technology. But here's the key. Meta's core social media business is so profitable that it easily funds these ambitious moonshot projects without jeopardizing the company's financial health. If Meta's vision for the metaverse pays off, even partially, the potential upside is enormous. Imagine a world where digital and physical realities blend seamlessly, creating new ways to work, play, and socialize. Investors today are essentially getting a free option on this future, as the market isn't fully pricing in the possibilities. Of course, regulatory scrutiny is a constant reality for Meta. Governments around the world are watching closely, and new rules could impact how the company operates. But Meta has faced these challenges for years, adapting its business model and compliance practices along the way. Much of this risk is already reflected in the stock price, making it less of a surprise for investors. Despite its impressive run, Meta still trades at a lower price-to-earnings ratio than many slower-growing blue-chip companies. Analysts expect Meta's earnings to grow at over 20% annually for the next several years, a rate that outpaces most of its peers and suggests there's still plenty of upside left. And the growth story is far from over. New initiatives like Instagram Reels and the monetization of WhatsApp are just beginning to unlock massive new revenue streams. These platforms are still in the early stages of their growth cycles, with huge potential to drive Meta's next wave of expansion. Meta Platforms continues to be a cash machine at scale, with a market cap around $1.87 trillion, EPS of $28.29, a PE near 26.28, 2024 revenue of $164.5 billion, and net income of $62.36 billion. At these levels, the market is paying for AI-driven ad efficiency and engagement gains. The debate is whether incremental capex into AI and new product surfaces can keep monetization outrunning expense growth. For the first time ever, Meta has introduced a dividend and launched a massive stock buyback program. These moves signal management's confidence in the company's future and make Meta even more attractive to a broader range of investors, including those seeking income and capital returns. In short, Meta is a cash machine with a dominant user base, proven resilience, and multiple growth levers that the market still underestimates. With its unmatched scale, relentless innovation, and a track record of overcoming challenges, Meta remains one of the most compelling stories in tech, and its next chapter is just getting started. Fourth, Toyota Motor, ticker TM, the world's most profitable automaker. While the market obsessed over pure EVs, Toyota stuck to hybrids, and now that strategy looks brilliant. Hybrids are booming, profit margins are strong, and Toyota's multi-pathway approach, hybrids, plug-ins, hydrogen, and EVs, reduces risk. The stock trades at a single-digit PE despite a fortress balance sheet and massive cash flow. Toyota is investing billions in next-gen battery tech, including solid-state batteries, a potential game-changer the market is ignoring. Their manufacturing expertise is legendary, giving them a huge edge as they scale up EV production. The Toyota brand stands for quality and reliability, a priceless asset as new entrants struggle with quality control. Shareholder returns are strong, with growing dividends and buybacks. The weak yen is boosting profits, giving Toyota even more firepower for future growth. Toyota Motor offers classic durability at a reasonable tag. Market cap roughly $256.66 billion, EPS of 304.97 Japanese yen, a PE of 9.41, 2024 revenue of 48.04 trillion yen, and net income of 4.77 trillion yen. With a hybrid-first strategy and deep manufacturing scale, Toyota's multiples imply skepticism about a rapid EV shift. If adoption continues to be mixed globally, that conservatism can read as a feature, not a bug. Bottom line, Toyota's cautious, pragmatic strategy is now paying off, and you get the stable hybrid business, plus massive EV upside for free. Finally, Visa, ticker V, the digital payments giant powering the global economy. Visa isn't a bank, it's a tech company running a massive payments network, taking a cut of trillions in transactions every year. With over 4 billion cards and acceptance at 100 million plus merchants, Visa is an essential part of global commerce. The market worries about consumer spending, fintech disruption, and regulation, but Visa's moat is nearly impenetrable. Even in downturns, the shift from cash to digital payments keeps driving growth. Fintech disruptors are now partnering with Visa, running their transactions on its rails. Visa's growth runway is huge, emerging markets moving from cash and new payment flows like B2B and government payments. Operating margins top 60%, and free cash flow is massive. Visa returns this cash to shareholders through dividends and aggressive buybacks. And Visa remains a toll road on global commerce with a market cap near $658.86 billion, EPS of $8.89, a PE of 38.26, 2024 revenue of $35.93 billion, and net income of $19.74 billion. You're paying a premium multiple for network effects, cross-border strength, and value-added services, so the key is sustained high-teens earnings growth to support that valuation. Put together, these 5 span defensive quality, platform scale, and deep value. The common thread is clear metrics to track: revenue durability, margin expansion, and the catalyst path that converts today's multiples into tomorrow's returns. The stock trades at a reasonable PE for a blue-chip compounder with double-digit earnings growth ahead. Regulatory risk is always there, but Visa's value to the ecosystem is too great to ignore. In a volatile world, Visa is a reliable, high-quality growth machine. There you have it, 5 high-quality companies trading below their true worth. Each has a powerful moat, strong fundamentals, and clear growth catalysts. The market's short-term fears are your long-term opportunity. Want to learn how to spot undervalued stocks and build real wealth? Check out my Value Stocks Investing Master Course, link in the description. For exclusive tips and in-depth analysis, join the Stocks Galore Patreon community. Now your turn. Of these 5 stocks, which do you think has the most upside over the next 5 years and why? Drop your pick and reasoning in the comments below. Don't forget to like, subscribe, and share for more investing insights. Let me know if you need further tightening or adjustments.